Hello traders. In this video, I will cover one of the most important concepts that you need to understand in order to trade successfully, and it's called the smart money concept. You look at the chart, determine the support level based on previous values. Then, when the price approaches that level, you expect another deviation to occur, meaning the price will go up, but you end up seeing your stop loss that you had standing here just get taken away and you don't get anything. You don't get any market reaction. The point of your stop loss here is only to make the price bounce back in the direction you initially assumed. I'm sure most of you who have experienced something like this will find it very frustrating. But what most traders don't know is that this is actually a common manipulation tactic used to control prices and steal profits from retail traders like you and me. So what is smart money? These are investors who have large sums of money, as in large banks, institutions, and hedge funds. And because these investors have a lot of capital to trade, they are the ones who move the market. So here are a few smart money concepts that you should explore to increase your percentage of profits as traders. The first is the concept of smart money in the area of supply and demand. One of the key concepts for understanding how smart money works. Supply and demand are levels that show a significant amount of money coming in or going out in that particular price range. These areas can be used as key levels that can define trading opportunities for you and me. Here's one example. We see the price chart. We also see a strong move up here. That is, we can notice this long candle. This means that strong demand for this asset has occurred here. And due to this, we can distinguish here this demand zone or this supply zone, from which we can further understand that there will be an upward reaction. The first reaction takes place respectively at this point. This happens on high updates. It's the zone's first reaction. The second zone reaction occurred at this point. So here was a more local case into this area. But after that, we can safely test this zone, which in fact is what we did here. And after that, we can open a position from here on the rise of this high. That is, already this price high is a zone of interest. This is just one example of how traders can use supply and demand zones. I'm sure some of you have noticed that these zones are very similar to resistance and support levels. And you're right, they are similar. And then the question arises, what is their difference from support and resistance levels? The answer is quite simple. For example, here the demand zone is fixed on aggressive price movements. This happens when we can see a large buyer or seller, and the support level is announced only after two touches. That is, in this situation, we see the first touch of the price and the second touch of the price. And only after that, when the chart is to the right of the line, we can put a support zone from which we can, for example, take a call option and put a stop for this zone. And we will end up having a stop loss because this zone will have already been taken down by that point. The concept of smart money assumes this situation. For example, here we can see that we have an aggressive behavior of large capital, which in this situation forms a support zone. And, in fact, from this support zone, we can safely open a call option, put stop behind the low at this point, or even lower for this price low. Here, everyone determines for himself. After that, we get an upward reaction. That is, in principle, the smart money zones differ from support and resistance levels. That is a support or resistance zone, for example. As here, we see a resistance level, which is formed under the slope. After that, then the price removes this level and goes down. Now let's move on to smart money concept number 2, which is market structure. Simply put, market structure is the concept of understanding the behavior, condition, and direction of the current market. Let's look at this chart as an example. But first of all, what do you think the market structure is in this chart? Is this an uptrend or a sideways trend? I'm sure most of you will answer uptrend because the price is going up. If that's the case, you're right. This is actually an uptrend. However, the reason why this particular market is considered an uptrend is not because it is just moving up, but because of the structure of the market. If you look closely at the market movement, you will see that it continued to form what are called higher highs and higher lows. So what we see here is that we have higher high, higher low, higher high, higher low. That's what upward price movement is all about. It comes back down, but remains above the previous low. That is, we have a minimum at this point, and the price doesn't update this minimum. From this, the given low is higher low. After that, we have a high, which is updated, and forms a new high. This is called a higher high, after which we have a formed low, or the nearest given formed low that price doesn't update. So we get a higher low, and so on. This is the concept of market structure. Here we see the opposite of a downward structure. This is where we see just the high. After that, we have a lower low. Then it updates the next closest low and becomes a lower low. Then it goes to lowers high. After that, we see the update of the previous low. That is another lower low, after which we see, again, lower high, and so on. So, once you've figured out the concept of market structure, it's time to move on to smart money concept number 3, which is called change of character. Simply put, a change in character is when price disrupts the previous market structure. This can usually be a sign that the overall trend will change. Let's look at an example. What we see here, for example, is that we have a top-down structure. It looks like this. After that, we can see what is happening here, the update of this line. Accordingly, this line is a change of character. That is, we can notice here that the low price has not updated, but the high price has updated again. And this is confirmation that the trend has broken. That is, we see a higher high here, and at the same time, we don't have a price low formed. That is, a lower low has not formed. Actually, that's what a change in structure means. Here we see that there was an ascending structure. There were rising highs and rising lows, followed by a downward move. And we can see that our low here has been updated. That is, our price has updated the low, not updated the high. This means that this thing is a change in the market structure, followed by a further downward movement. Now I suggest to move to practice on the platform where I usually trade. Here we see an upward movement, rising lows, after which we had a break of the structure. That is, the price has updated the nearest low. We got a lower low, and there was a change of movement here. That is, as I said before, in this situation, the price forms the next level of demand. And accordingly, we can open a downside position on our structure in this zone. That is, we take the high price, take a small margin, look globally at the chart, and open a put option to continue the downward movement. That is, I take the current price, use 25% of the deposit, choose take profit. During this time, the price has gone slightly below. So I will open a position from the current point, opening position. Great, we can see that the position has opened, we have a take profit, we have an order, and the position is opening. I will show the result in the video. If it was useful, put a like, write questions in the comments, and see you soon on the channel.